Welcome to our discussion about FASB Accounting Standards Update 2016-09, Improvements to Employee Share-Based Payment. Over the next few minutes, we will talk about the FASB's amendments to simplify accounting for share-based payments. My name is Daniel Lim, and here with me today is Luis Santa Cruz. Both of us are members of the Employee Compensation Topic Team in KPMG's Department of Professional Practice. So Luis, what is the intention of this ASU?
The intention of the ASU is to reduce the cost and complexity of accounting for share-based payments. However, some changes will likely increase volatility in reported earnings. In addition, there are different transition provisions for each issue, which we must keep in mind.
The first change from current GAAP is that the ASU eliminates the requirement to track APIC pools related to excess tax benefits. Instead, all excess tax benefits and tax deficiencies are recognized as an income tax benefit or expense in income statements in the period these amounts are deducted on the income tax returns. They are not anticipated when determining the annual estimated effective tax rate. Instead, they are discrete items in the reporting period in which they occur. The recognition of excess tax benefits and deficiencies and changes to diluted earnings per share are applied prospectively. In addition, the guidance eliminates the requirement that excess tax benefits be realized before companies can recognize them. Under current GAAP, companies cannot recognize excess tax benefits when an option is exercised or a share vests if the related tax deduction does not reduce income taxes payable. This can happen, for example, if a company is in a cumulative net operating loss position and isn't paying current taxes. Under the new guidance, the benefit will be recorded when it arises subject to normal valuation allowance considerations as it relates to the net operating loss carryforwards. Companies will apply this part of the guidance using a modified retrospective transition method and record a cumulative effect adjustment in retained earnings for excess tax benefits they have not previously recognized. A company must assess the realizability of any deferred tax assets it records upon adoption as a result of recognizing excess tax benefits. If a valuation allowance on those deferred tax assets is necessary on the date of adoption, the company will record the valuation allowance in retained earnings. As a result of these changes, volatility in reported earnings likely will occur because all effects associated with differences between the expenses and their income tax deduction will be recognized in the income statement. In addition, some entities will face difficult judgments about whether to record a full or partial valuation allowance when they record deferred taxes for excess tax benefits.
Under the ASU, all tax-related cash flows resulting from share-based payments are to be reported as operating activities along with other income tax cash flows on the statement of cash flows. This is a change from the current requirement to present windfall tax benefits as an inflow from financing activities and an outflow from operating activities. Either prospective or retrospective transition of this provision is permitted.
Under the new guidance, entities can elect to estimate the number of awards that will vest when determining compensation costs, current GAAP, or to reverse compensation costs of forfeited awards when they occur. Be aware that estimates of forfeitures will still be required in certain circumstances, such as at the time of modification of an award or issuance of a replacement award in a business combination. The amount allocated to pre-combination service in a business combination is reduced by the estimated forfeitures. However, the amount allocated to post-combination service is not reduced. Entities that elect to recognize forfeitures as they occur will record a cumulative effect adjustment in retained earnings as of the beginning of the year of adoption. Electing to account for forfeitures as they occur will create greater volatility in earnings if forfeitures occur unevenly throughout the vesting period. This election applies to all types of awards, including shares, share options, employee stock purchase plans, and other share-based compensation type awards. The election applies to forfeitures for failing to meet service conditions. Compensation cost continues to be based on the best estimate of outcome of awards with performance conditions. Entities could be required to continue to recognize compensation costs for an award expected to be forfeited. This could occur if a layoff in a future period is planned, but the award does not accelerate vesting upon involuntary termination.
The ASU lets entities repurchase a greater number of an employee's shares for tax withholding purposes without resulting in liability classification, in contrast to current U.S. GAAP. Currently, employers are permitted to withhold shares upon settlement of an award to satisfy the employer's tax withholding requirement without causing the award to be liability classified. However, the amount is strictly limited to the employer's minimum statutory tax withholding requirement. The simplification allows entities to withhold an amount up to the employee's maximum individual tax rate in the relevant jurisdiction without resulting in liability classification of the award. Entities record a cumulative effect adjustment in retained earnings as of the beginning of the year of adoption. For purposes of determining the cumulative effect adjustment, entities will not be required to determine the effect on retained earnings for awards already settled. It's important to note that the ASU allows entities to determine a single maximum rate for all employees in a jurisdiction, rather than determining an individual rate, which could simplify the withholding processes. Some jurisdictions place restrictions on an employer's ability to unilaterally withhold more than the required amounts, which may result in implementation complexities if some employees do not authorize higher than required withholdings. In addition, the ASU clarifies that all cash payments made to taxing authorities on the employee's behalf for withheld shares should be presented as financing activities on the statement of cash flows. This change will be applied retrospectively.
The ASU provides for certain private company practical expedients. Louise, would you mind walking us through these?
Sure. There are two provisions that are only available to companies that are not public entities. First, a practical expedient for determining the expected term of certain share-based payments, which would be adopted prospectively, and second, a one-time policy election for measuring all liability classified awards at fair value to intrinsic value upon adoption of the ASU without considering preferability. If the simplified method is elected to determine the expected term, it applies to awards with service conditions and for performance conditions that are probable of achievement. If meeting the performance condition is not probable, non-public entities are required to use the award's contractual term if the service period is implied. If the service period is explicitly stated, the simplified method is required. Non-public entities that elect the practical expedient to determine the expected term of an award apply the simplified method prospectively to all awards measured at fair value after the adoption date. Non-public entities making the one-time accounting policy election to change the measurement of liability classified awards from fair value to intrinsic value record a cumulative effect adjustment to retained earnings as of the beginning of the year of adoption. This slide here shows the effective date of the ASU. Daniel, would you mind going through whether early adoption is permitted and how entities should be applying this?
Sure. It is important to highlight that early adoption is permitted in any interim or annual period provided that the entire ASU is adopted. In addition, even if an entity early adopts amendments after the first interim period, the adoption date is as of the beginning of the year for the issues adopted by the cumulative effect and prospective methods. Any adjustments to previously reported interim periods of that fiscal year should be included in the year-to-date results. If those previously reported interim results appear in any future filings, they are reported on a revised basis. So for example, a company that adopts in Q2 would report the second quarter under the new principles and adjust the year-to-date amounts for the Q1 impact to the new principles so that the year-to-date amounts are stated on the new principles. You would not be reporting any Q1 balances in the Q2 10Q, so these would not be revised. When entity next reports those prior periods, they would be as revised for the adoption. For a public company, that would be when the quarters appear in the notes to the 10K, as well as when those periods appear in the next 10Qs as prior periods. Also, if there are any registration statements in the meantime. And that wraps up today's accounting update. Highlighted on this slide are key points to remember. While the amendments are aimed at reducing the cost and complexity of accounting for share-based payments, they will likely result in significant volatility in reported earnings. For more information, please see Defining Issues 1611.